Good morning, students. Namaskar, Suprabhat, Sat Sri Akal, Vanakkam, Kem Cho. I am C. Ankit Sharma, your income tax faculty, and we are in our fourth session of capital gain topic. So this is our, you can say, second last topic for the capital gain topic, and we will be discussing today the remaining provision of assignment number 1 and the assignment number 2, which consists exemption and some special provision regarding rate of taxes in case of capital gain. So I believe that you all are good and of course studying very hard to achieve your goal as soon as possible. So let's take good morning wishes from all of you. Okay, good morning Diksha, good morning Sudhanshu, Darshan, Bhumika. Darshan is asking a question. I will let you know the answer, of course. Sushil Kumar, good morning. Mohammad Suhail, Sankaran. Vanakkam. Okay, Mr. Sankaran, Vanakkam. Of course. Next, Madhav, good morning. Loga Sundar, good morning. Singh Rajiv Kumar, good morning. Suhail. Divyat, good morning. Vishwanatha Reddy, good morning. Darshan, I have a doubt. As usual, always he has doubts. So I will answer your doubt. Don't worry. Then Rajesh is good morning. And Manisha, a very good morning. And I welcome you all again in our class. So let's see what Darshan wants to ask. Sir, in case of destruction, the sales consideration is the insurance receipt or the FMV of the asset on the date of receipt. Yes, you are correct. The insurance amount, if you are receiving in monetary terms, that will be your sale consideration. Or if you're receiving a new asset or another asset in exchange of destruction, then the FMV of that asset at the time of receipt. Okay. Okay, Darshan is also having a doubt. I have a doubt in the page number 34 in the PDF you uploaded, sir. I am unable to understand that exemption of 2 in scenario number 1. Okay, I will explain you. Do not worry. Page number 34. I will check it out and I will explain it to you. Okay, good morning, Rishita. I already uploaded the chart, the remaining chart, and the remaining notes yesterday night. So I believe that you must have downloaded it, or if not, then please download it after the class. Okay. So before starting, as we have a routine to share a good morning, or you can say that a thought for the day. So today, thought for the day for all of you is this. And it says, everything is hard before it is easy. So until you do something, until you start trying something, everything looks very difficult in this life. Even suppose when you start learning cycle, that how to run a cycle, you might be thinking that this is the most difficult work in this world because you are not able to balance it properly. So whenever you start trying anything, you find it every time something is difficult. But when you start doing it with your focus and with your interest and with a view that you want to do it, however it is, you need to complete that challenge, then you'll find it easy. Suppose somebody is thinking about that one day people will flying in a plane, in an aircraft. So before they start doing about it, they must be thinking or imagine this thing like a dream. How it's possible that someone will fly in some flying object and not 1 or 2 people, like 100 of people in a single object, and they are going to fly from one country to another country, etc. So when somebody is thinking about this starting, it must be very difficult. But when people start trying something, start doing something with specific conviction and hard work and commitment, things happen. In the same way, like we launched Chandrayaan 3. So suppose in the starting, it must be feeling that it's so difficult thing for our country. But when people have commitment, they have their focus, they are ready to do hard work, then everything is possible in this world. And once you do it, you must be finding it very easy. So when you learn how to drive active or cycle, you must be thinking, oh, this is so simple. But initially, you must be finding it very difficult. If you start learning to drive a car, you must be finding it very difficult because there is clutch and brake and accelerator and gears, etc. It's very difficult. It's difficult and hard before it is easy. And when it will be easy? When it has been done. Okay. So that was our thought for the day. Okay. Vishwanatha Reddy also have some doubt. Sir, I have one huge question on capital gain from joint development of residential apartment. If you permit, I will pose the question. You can post it over here. I will take the screenshot, etc. and I will try to solve it in the next class, because if it's a huge question, it will take time. And I will make one thing sure, that I will make that huge question in simple steps. So the other students who are watching this class, first of all, I need to make them understand the question. And then I will solve it in the next session. So you can try that. Okay. So let's find it. What we were discussing in last notes, there was section 45(5)(a) regarding the specific agreement. And I said that I will discuss the proper example in next session. So today, before starting the class, before starting the MCQ, let me solve a simple question of that section 45(5)(a). So that might be a confusion that can be cleared easily. After that, we will start taking our MCQ test, and then we will continue our normal notes or provision class. So let me solve the question with the help of an example. The same example, what I have written in the last class. So I have already written that same example for you. So we will save our time. The same question is here. Section 45(5), it was 5A. Mr. A purchased a land on 1/11/2010 for 15 lakh rupees. Okay, same question. Agreement with developer on 1st November 2015. So that date will be considered as date of transfer. Clear? Date of issue of completion certificate is 1st 11/2022. So till here, everything is normal question, is the same question what we have discussed in the last class. Now the solution comes here. The solution was also correct in the last class. Just a simple clarification for all of you to understand this provision more clearly. So suppose Mr. A transfer his share to developer on 1/11/2020 for rupees 100 lakh. So if the assessee transfer his share before completion certificate has been issued. So this case says that if the share has been transferred before, and if it is transferred on or after, then these provision will be applicable. So if the shares has been transferred before to the date of completion certificate issued by the prescribed authority, the capital gain will be chargeable to tax in the assessment year 2001-22. Now the problem is what? What confusion has been created in the class, that as per the literal meaning of the section says this. If you will see, the section says, in case of land development agreement under section 45(5)(a), if I'll explain you with the help of a diagram, it says that is the individual HUF transferring his share in the project on or before the date of issue of completion certificate? And if it is yes, then it says, the section literal definition says capital gain tax liability would arise in the previous year in which the property is handed over to the developer. Now this creates actual confusion, that if we transfer our share before the date of issue of completion certificate, then what will happen? It says the capital gain tax liability would arise. in the previous year in which the property is handed over to the developer. Now, the problem in our example is assessee purchased that property on 1/11/2010. The handed over it to the on 1/11/2015. And date of issue of completion certificate was 1/11/22, but the share has been transferred on 1/11/2020. So we charge it in assessment year 21-22. The problem is with only the chargeability year. All other provision has already been sorted. There was no confusion about it. The confusion created because of this language which has been written in the section, and it says that if this case happened, if the share has been transferred before the date of completion certificate issued by the prescribed authority, then capital gain would arise in the previous year in which the property is handed over. Clear? Now the language suggests that the capital gain should taxable in the year in which property was handed over. That means in this assessment year. Assessment year 1670. Now, practically, you should understand that if she or he transfer his shares on this date, that means we come to know that this case is applicable when he transfer his share before the issue of completion certificate. So, practically, we came to know that taxability will arise. In which year? In 2020. So, how it's possible practically that if I came to know that my taxable capital gain liability has been arise according to part 1 case, that means as per this case, then how it's possible to charge this gain in assessment year 1670? So in 2020, we will come to know that we are falling in before case or after case. So we came to know in 2020 that before case is applicable upon me. And in 2020, now the section says the capital gain tax liability would arise in the previous year in which the property is handed over. That means in assessment year 1670. So how somebody can taxable his gain in 2020? He comes to know in the year 1670. So if we have a time machine, this is possible in only that case. So do we have a time machine? So if I have a time machine 2020 and I came to know, oh, this is wrong. My capital gain should be taxable in the year property has been handed over. So I need to set a time machine in 2016-17 year case, and I went back to there and then I need to calculate my capital. So practically it's not possible. As a same case in case of compulsory acquisition. Remember section 45(5). When it says there is OC, original compensation, there is EC, that is enhanced compensation, but there the case of reduction compensation. If the court order that the compensation should reduced, then we cannot recalculate the capital gain in the earlier year in which we already calculated capital gain. So what we do? We assume that the earlier capital gain calculation is nullified and we recalculate it only in the year in which the code has passed the order, because we cannot change the retrospective calculation of any year because we do not have time machine. The same problem arises in this case because the section language says that it should be taxable as it would have been taxable in 1670, but we cannot do so. So the literal meaning suggests something else, but the practical meaning is this. What the section want to tell, that if this situation arises, then we will assume that it should deem to be taxable, in the previous year in which the property is handed over. Deemed to be taxable. This is written in the section. If you will read the section properly, it has been written over here that you can see it has been written over here that and the capital gain tax liability would be deemed to arise in the previous year in which such transfer took place. So provision says that the intention of the section, literal meaning says that it should be taxable in assessment year 16-17, but that is practically not possible. So we have to tax it in the assessment year 21-22 or in the year in which we came to know that the share has been transferred before completion of the property. And this provision, let me tell you, is open for debate. If somebody want to debate, it is debatable issue because the section language says something else. But practically, if the literal meaning is correct, then it is against the department. How? Because handed over right in 2015 and in 2020 we transfer our share. So assessment year 21-22 should be taxable as per practical provision. But the department meaning is correct. And if you want us to taxable in this 16-17, then whatever will be tax liability, we cannot pay it in 2021-22 because there is a time limit to charge or recover tax from the assessee. In some cases, it's 3 year as per section 147, 148 assessment or 6 year cases. So might be these 3 year time period has already been elapsed. So if assessee is not going to pay tax in 2021-22, department would be really difficulty to recover this as per the concept of assessment. So that is a debatable issue, and as for the benefit of department, it is also to taxable it in the assessment year 21-22. So it's quite complicated, you can say, because the concept is saying something else, but the practical situation is something else. But you do not worry, I am solving this for you, and you can write down it. That's the literal meaning. It should be taxable in 16-17, but practically we need to taxable it in this year only. Clear? So the year was the actual problem, and now it has been sorted. The other provision will be remain the same as period of holding. Of course, it will be from 2010 till 15 because the date of transfer will remain 2015. Then the sale consideration was same 100. Index cost of acquisition, etc. Index cost of improvement, there is no difference. Transfer is of course my 15-16, and that was 10-11 my this situation. This scenario says that if it is transfer on or after 1/11/2022, in that case, sale consideration will be the value and any cash has been also paid. So we are assuming that 15 lakh cash paid. So 1 lakh 115. Period of holding will remain same. There will be no change in period of holding in this case also. That is 2010-15. Then less index cost of acquisition, etc. Same concept. So that will be answer. So the confusion was only for this scenario. That in this case, what will be the chargeability year? So practically it can be only assessment year 21-22. Clear? So that was the confusion we just discussed. Moving on to our provision, and before that, first of all, we need to complete our MCQs. So now there's practical MCQs for the calculation, and I believe that you must have with your pen, paper and calculator for our MCQ test. So I hope you all are ready. Let's set go. Okay. So Ms. Chunaf already sent a huge question on section 45(5)(a). Do not worry, I will solve it for all of you, and I'll try to first of all decode the question. So in examination also, if there is any numerical, especially for capital gain topic. So capital gain numerical have very special character. They are huge generally. Assume if examiner going to frame a capital gain question for compulsory acquisition. So it will be huge, but the solution is very simple. We need just to find out three things: period of holding, long-term, short-term, year of chargeability, and what should be the cost of acquisition, because sale consideration is very simple to find out. So in capital gain, the question might be for 10 lines, but the solution is for only 3 or 4 lines. But in other cases like salary, house property, PGBP, the question if it is for 5 or 6 lines, the solution might be more lengthier than the question. But capital gain solutions are very, very easy. So he sent the question. I will decode the question. I want to make you understand that what is the exactly question says, and then I'll solve it for you. So good morning. Some lazy students also joined. Aisha, why are you late? Okay, Komal and Darshan. 100 lakh is the sale consideration stamp duty value. There's section 50C, what we have discussed regarding land and building cases, Darshan. So whenever there is a sale of land and building, we need to apply section 50C. So if in the question stamp duty value has been given, then we need to compare it. So in this example, we assume 100 lakh is the only value which has been given. So we took it. So if there is stamp duty value also given, so we need to find section as per section 50C, the sales consideration. Okay. Aisha is asking, sir, what is the difference between handling over and transfer? Handling over is just a possession, and you make an agreement with him, but transfer include the possession as per section 247. So still there is transfer at the time of handed over, but we will charge capital gain only in the year in which he transfer his share, in which he or she will transfer his share. Yes, only possession has been given, but the ownership is transferred at the time of transferring the share. So they both are different things, but as per section 247 transfer definition, we will assume that the transfer has been taken place at the time of possession of the property with the agreement they made between them. Okay, Aisha is saying, sorry, sir, some issue with the connection. I had to join via mobile app, then switch over to desktop. Okay, no issue. Later or sooner, you should be on the right path. That's what matters. So now question number 5, please read it carefully and send the solution. R owns a house property which was purchased by him and was destroyed by fire. And R received read it and please solve it. The said property was destroyed by fire on 3rd April 2015. So that is the transfer year, okay? And R received a sum of 50 lakh for the insurance company, from the insurance company, of course, during the previous year 2022-23. The market value of the property on 1/4/2001 was 4 lakh. So compute the capital gain. Okay, somebody has sent the answer. Bhumika is saying B. And Vishwanatha Reddy is also saying B. Okay, more answers I need. Concurrent is saying C. Sorry. Okay. Madhav is saying A. Krati is saying C. What is the index value for 1516? Student, you should have that with yourself. Sorry. So, okay, correct answer is B. So the sale consideration will be 50 lakh and the cost of acquisition is 4 lakh. Transfer year index will be 1516 and the purchase year, because it's before 1/4/2001, will be 100. So the correct answer is B. Moving on to our next question. Mr. Ram has made an agreement to purchase a building from Mr. Raman for rupees 10 lakh and paid rupees 1 lakh as advance to Mr. Raman on 1/10/2021. Mr. Ram was not able to pay balance consideration within time as per agreement to Mr. So Mr. Raman forfeited advance of rupees 1 lakh in previous year 22-23, in which head 1 lakh is going to be taxable. It's too easy to solve. Okay. So what is the correct answer of question number 6? It's very easy. Send the answer as soon as possible. So the correct answer is, of course, question number 6 is income from other source. We have already discussed the provision in section 51. Next, Mr. Raman invested rupees 1 lakh on the purchase of gold jewelry on 28th March 2005. On 8th February 2016, he started a business of dealing in jewelry and convert his holding into stock in trade. FMV of the gold ornaments was on the date of conversion was rupees 4 lakh. These jewelry were sold in the previous year 22-23 for a sum of rupees 5 lakh. Compute the capital gain and business income. Look, in the question, we need to find the information which is useful for the purpose of solution. All the information, it does not mean that has been given in question, we need for the purpose of solution. So the relevant information for the purpose of solution we need in always solving a numeric. So in this question, first of all, you should understand that this example is related to section 45.5, that is conversion of capital asset into stock in trade. Sorry, not 45.5, it is 45.2. 45.5 is compulsory acquisition. So it's conversion of capital asset into stock in trade. First of all, you should find it that this provision related to that concept. Then you should remember or recall or think what is the implication of that provision. And it says, at the time of conversion, that date we take as a transfer date. But the chargeability year is the year in which that stock has been sold. So as per this concept, now start trying to solve this question. So it will be really easy. So first of all, decode the question, find your relevant information, apply the provision, and then solve it. Okay, question number 7 answer I am expecting from all of you. Darshan is saying A. Well done. Very well done, Darshan. So the correct answer is A. Look, solving PGBP is too simple. Because PGBP income will be your selling price, that is 5 lakh, and the FMV at the time of conversion, that will be taken as purchase consideration. So what is the sale consideration for the purpose of capital gain will automatically become the purchase price for the purpose of PGBP. So 5 lakh is the sale, 4 lakh is the cost. So 1 lakh will be the business income. And capital gain you might have been calculated, that will come 175,222. Question number 8. A firm consists of partners, namely A and B. B retires from the firm on 11th August 2022. The firm transferred its land to B in settlement of his account. The market value as on the date was 32 lakh. The land was acquired by the firm on 9 September 2004 for 10 lakh rupees. Compute capital gain in the hands of the partnership firm. So now you should recall the provision regarding the transfer of capital asset by a partnership firm to the partner. And section 45(4) is having the provision for this concept, in which it says, if any partnership firm transfer asset to partner in any situation, the FMV will be taken as the sale consideration at the time of transfer. That has been given in question. Cost, period of holding, indexation concept will remain the normal case. So kindly apply that and tell me the answer. Question is saying B. So the correct answer is correct. Darshan is saying B. The correct answer is B. Well done, Darshan. High five from Wi-Fi. Okay. Next question is 9. Mr. Ram applied for EC. Okay, enhanced compensation for his property which was compulsory acquired by government and received EC of rupees 5 lakh in previous year 22-23. Index cost of acquisition of that property was 2 lakh. Index cost of acquisition improvement was 40,000. Calculate the capital gain on EC for assessment year 23-24. Yes, eighth answer was B. Rajiv Kumar. Well done. Bhumika, you are also correct. Well done. Question number 9th answer is very, very easy. Kindly send me as soon as possible. Vishwanatha Reddy is saying A. What is the provision regarding EC, enhanced compensation? You will only solve the numerical wrong if you apply the provision without learn them. So the provision for EC regarding the cost of acquisition and for cost of improvement was that it will always be nil. Only expense of transfer can be deducted out of EC. There will be no cost of acquisition, no cost of improvement ever in case of EC. So again, the cost or improvement value which has been given in question is just to confuse you. I just told you it is not necessary, it is not compulsory, it is not mandatory that every information which has been given in the question need to be utilized in the solution process. No, there might be some information which just make to confuse you. So be focused, do not get confused. So the correct answer is D, because you cannot deduct any expenditure. You can only deduct expenditure on transfer out of EC. I hope it's clear, Mr. Vishwanatha Reddy. The correct answer is D. Okay. Somebody also saying E. Sushil Kumar, A is the wrong answer. EC is charged in which year? It is received and COA will be nil and cost of expenses, if incurred, can be deducted. Manisha is saying this. Manisha, kindly remember EC will be taxable in the year in which the final order of the court will come. You are writing it is received, but the correct is when the final order of that court, etc., will be come in that year, it's going to be taxed. Other thing is COA, etc., will be nil. That is correct. Okay. So, last question, 10. Mr. Chinmoy Das is saying something. C, sir. The correct answer is D. Okay, Mr. Chinmoy. Question number 10. Mr. Ravan sold equity share for rupees 10 lakh on 1st April 2020. Actual cost of acquisition was 8 lakh. Price on recognized stock exchange, date of purchase was 31st January, that was 11 lakh. Calculate taxable long-term capital gain. So this is the question what we are going to discuss today. In the last class, we discussed the provision regarding the cost of acquisition in case of your asset has been transferred on or after 31st March 2018. So I have told you that we will discuss some question regarding it in our next class. So first of all, we will discuss that question. Then you can only you can solve that MCQ which we just skipped. Okay. Question number 10 is related to those provisions. That is the last provision for assignment number 1, which we are going to discuss. After that, we will move on to our assignment number 2. So that was the provision which we discussed in the last class. And it says that if equity shares on which STT has been paid, and if it is transferred up to 31st March 2018, that is capital gain exempted. If they are short term, then that will be taxable as per section 111A at the tax rate of 15%. And if it is long term, then on or after transfer 1st April 2018 under section 1128 will fall and tax will be 10% without index. Now, finding the cost of acquisition for these kinds of shares have a special provision. It says if they purchase before 1st February 2018, then cost of acquisition will be actual purchase price or FMV on 31st January 18, whichever is higher. That higher should be compared with the sale consideration, and whichever is lower will be your cost of acquisition. Clear? The provision says, the concept says that actual purchase price or FMV, you need to find these value, and then we need to find the cost of acquisition regarding it. If purchased on or after 1st February 18, the cost of acquisition will be your purchase price. So the concept says the actual purchase price, whatever has been given in question, we need to take that, the actual purchase price, and then FMV or sale consideration, whichever is lower, and out of these two, whatever is higher, that is going to be your cost of acquisition. Let's solve it with the help of example. So first of all, you need to see that if it is purchased before 1st February 2018 or after. So if it's after, the situation is very clear that the actual purchase price will be your cost of acquisition. And if it is purchased before 1st February 2018, then this concept to find out the actual cost of acquisition will be applicable. Clear? That is actual purchase price. We need to, it has been given in the question, or FMV on 31st January 18, or sale consideration, whichever is lower out of FMV or sale consideration, that must be taken, and then it need to be compared. Let's solve with the help of example. First of all, read the provision regarding it. Then we will solve the question. In order to minimize the economic distortions and curb erosions of tax base, it is proposed to withdraw this exemption. The earlier exemption was section 1038, which exempted, as we saw, that if it is sold up to 31st March 18, it is exempted. A new provision not proposed, it has been already implemented. Long-term capital gain arising from transfer of an equity share or a unit of an equity-oriented fund or a unit of a business trust shall be taxed at the rate of 10% of such capital gain. This is section 112A, and we have discussed in last class this also, that up to 1 lakh will be exempted, and anything above 1 lakh is going to be taxable at the rate of 10%. Earlier, this was fully exempted. So the new provision to tax the long-term capital gain we are moving on to the cost of provision part. To provide an interim relief and to provide an opportunity to the investor to plan their affair, the investor are given an option to assume the cost of acquisition. Assume the cost of acquisition. So this is the theoretical provision regarding the cost of acquisition chart we were discussing. So assume the cost of acquisition of the shares forming part of their portfolio different from the one they have actually paid to acquire them. The cost of acquisition of a listed equity share acquired by the taxpayer before 1st February 2018 shall be deemed to be the higher of the following: the actual cost of acquisition of such asset, or the fair market value of such share, or actual sale consideration accruing on its transfer, whichever is lower. So the concept says, what will be the cost of acquisition? Higher of the following: the actual cost of, that means purchase price, the fair market value of the shares, or actual sales consideration, whichever is lower. So we need to find out the lower out of them, that is FMV of the shares or the sale consideration. First of all, we find the lower out of them, and then the purchase price and this value, whichever is higher. Okay. So now moving on to the provision with the help of an example. Scenario 2, first of all, scenario 1, it's saying sale consideration is 10 lakh. Date of sale is 31st March 23. The actual cost of acquisition is 8 lakh. Quoted price on the stock exchange is 850. So if you will see, and if in this case, we need to find out, let's take scenario 2 first. Scenario 2 says that the sale consideration is 10 lakh, and you can see the actual cost of acquisition was 8 lakh, and the FMV of the price on the stock exchange is 7,50,000. So we need to find out the cost of acquisition as per the above provision. The provision says that we need to find the cost of acquisition, first of all, taking the FMV and sale consideration, whichever is lower. So the FMV has been given 7,50,000 and the sale consideration has been given 10 lakh. You can see. What is the concept? It says the FMV or sale consideration, whichever is lower. And this lower need to compare with the actual purchase price, whichever is higher. So in this example, the fair market value has been given 7,50,000. Your sale consideration has been given in question is 10 lakh. So out of these two, the lower is 7,50,000. And now this 750 is going to be compared with this value, and whichever is higher will be your cost of acquisition. Skip this case. There's a wrong date in it. That's why we are skipping it. Now scenario 3 is saying sale consideration is whichever is higher. That means 9 lakh. So that is my deemed cost of acquisition. Clear? Now the fourth scenario says the sale consideration is the sale consideration is 10 lakh, actual cost is 8 lakh, and FMV is 11 lakh. So we will take FMV and sale consideration, whichever is lower. The lower is 10 lakh, and this 10 lakh and actual cost was 8 lakh, whichever is higher. So it will come 10 lakh, which is higher. Now this date of sale is 1st April 22. The date of purchase is after 1st 30 on 2018. 1st March, which is after January date. So in this case, normal cost of acquisition will be taken. So the provision says if it is purchased after 1st February 2018, then the normal provision. So case scenario will be a normal provision in which the cost of acquisition, which is actual cost of acquisition, will be taken. So in scenario 2, 3, 4, and 5, we need to solve, and we have seen that In all scenario, the deemed cost of acquisition will be find out. First of all, taking the sale consideration and FMV, whichever is lower, and that's lower need to be compared with the actual cost of acquisition, whichever is higher. So that will be my deemed cost of acquisition. We cannot take the benefit of indexation. So in all these cases, deemed cost of acquisition is over here. We cannot take indexation benefit. This is the long-term capital gain 2 lakh. Out of this 2 lakh, 1 lakh will be exempted and balance 1 lakh is going to be taxable only. In this case, 1 lakh long-term capital gain. In this case, there is no capital gain, of course, because the deemed cost of acquisition and sale consideration both are equal. So there is no capital gain technical. And in this case, the capital gain will be 2 lakh rupees. I hope it's clear. So in scenario 3, the cap gain was 1 lakh. So taxable exemption will be 1 lakh. There will be no taxable capital gain. We will solve more questions regarding it. So that was our section which we have left in the last class. Now we have completed this provision. There is some special provision, FMV. If these are listed share, highest price quoted on stock exchange on 31st January 18 will be your FMV. If no trading has been done, the highest price on a date immediately preceding 31st January 18 will be taken. FMV in case of unlisted share, that will be equivalent to NAV on 31st January 18. The tax treatment says concessional rate 10% will be chargeable on long-term capital gain. The tax rate will be 10%. Adjustment of unexhausted basic exemption limit. This will be discussed in assignment number 2 of capital gain. What we are just going to discuss after this section. No deduction you can claim out of section capital gain section 112A. That is also a part of our assignment number 2 that we will discuss. No rebate you can claim from long-term capital gain taxable under section 112A. That is also a part of assignment number 2. So we will discuss these provision in assignment number 2. Section 50C, 50CA, 50D. We have already covered these section in our last session. That was our assignment number 1. Moving on to our assignment number 2 provision. So the quotation for this assignment says, and it's very real also, of course, if there is any problem in your life, the solution lies only with you. So you are the solution. Whatever problem you have in your life, only you are going to solve it, or only you can solve it. If you are waiting for someone else, that somebody else will come and will solve those problems for you, that is not going to happen. So whatever problem you have to fight for it, and you are the only one who has the solution to solve that problem. Okay. Now the computation of tax on capital gain and exemption. This is our capital gain assignment number 2. So before starting this assignment, let me take the queries if there is anyone is asking. So, okay, everything is clear? Okay. Aisha is asking, why is this benefit given under this provision? Now, this is very difficult question to be answered. And that is why. We cannot answer why in law, because the law has been made and technically we have to follow it. We cannot ask why, because the lawmaker knows the reason why they actually make some provision. So only 2% technically, from my point of view, know the answer of why. One is the lawmaker and second is God. They only know the solution of this question why. Because whatever concept they are thinking before making any provision, so the logic they have, they know why they make this provision, but technically I can tell you that what is the reason behind it. Up to 31st March 2018, long-term capital gain on listed equity share, etc., on which STT has been paid was exempted. So till 31st March 18, it was exempted. There was no tax. So when government reformed that section, when government deleted that provision, when government removed that exemption, so the assessee was very furious. Those person having long-term cap gain earlier that was 100% exempted, and now it is going to be taxable. So government just provides some benefit to make them happy. That the tax rate will be 10%, cost will be this. So you might not have been that kind of taxability in your hand, which will have if this provision has not been made, and directly the section 1038 might have been removed. So removing section 1038 was a harsh decision, but for that harsh, they compensate after making a provision on section 1112A. So there is a benefit for in the case of tax rate, and of course in finding the cost of acquisition. So that was the reason behind it. Okay, but we should not ask why in any law provision, because we are just need to follow it. The provision, we cannot ask why it has been made like this. The same way, you cannot ask why 2.5 lakh rupees exemption for those having less than 60 years of age, or 3 lakh for 60 to 80 years of age, or more than 80 years in case. Why 5 lakh? Why it's not 6 lakh? Why it's not 4.5 lakh? Why the rebate is 12,500 only? Why the tax slab rate is 5% or 20% or 30%? Why? We cannot ask it, even though there is a logic behind it. But again, we just need to understand the provision for the purpose of intermediate, etc. When you will be a chartered accountant, you will find out why provision is made like this. Why these percentage, why this age criteria, why that exemption limit is 2.5, 3 or 5. So everything has a logic, but for the time being, we need to just understand the provision and to solve the question in the examination. Okay. So computation of capital gain and exemption concept we are moving on to understand. So this tax rate status, the tax rate concept I will teach you after these exemption provision. First of all, we need to understand the exemption provision. Then I will make you understand what is the tax rate structure, how to calculate tax, and what are the slab rates. So first of all, we are discussing Section 54 or Income Tax Act, and these talk about the capital gain exemption. Till now, we discuss in the capital gain that we need how to find out the long-term capital gain or short-term capital gain or loss, whether it's a depreciable asset or it's a non-depreciable, whether it's a slum sale, where it's a compulsory acquisition, when there is conversion of capital asset into stock and trade, when there is specific development agreement under section 45(5)(a), if there is buyback of share, if there is liquidation, if there is gift involved, if there is those cases in which transfer not regarded as transfer. What will happen if there is forfeiture of advance money receipt? What will happen in case of destruction of asset? So we just understood the provision till how to calculate the capital gain, long-term, short-term or loss. But the story is not yet ended. So till now, if I'll discuss with the provision concept, we know how to find the period of holding, that is for long-term, short-term purpose. For the in respect of numerical treatment, we know how to find this. How to find the sale consideration, we have discussed. How to find the index cost of acquisition or cost of acquisition in different situation. Index cost of improvement, and then long-term, short-term capital gain or capital loss. This is the journey so far, but picture abhi baki hai. It's not ended. Okay, and what is the picture? First of all, understand why the exemption has been made. Now, practically, because we are talking about the capital gain concept in which asset has been sold. So the gains are huge generally. Suppose if somebody has purchased land in 2010 for 10 lakh, and in 2022, now he's transferring it. So the value might be very high in comparison to the purchase price. That might be 150 lakh. So if we'll apply index cost of acquisition concept, even then the cost was 10 lakhs, so it might will go twice or thrice of this value. We can say it's 25 lakh approximately. Right? Still there will be gain of 125 lakh, and let me tell you students, the long-term capital gain chargeability rate is 20%. There is no slab rate concept. It's going to be taxable at the rate of 20%. These rate we will be discussed after this exemption provision, what we just skipped. Okay. So that technically, if you will see, the tax will be 25 lakh and surcharge and education cess, etc. So it is a huge tax liability for any purpose. So if there is any salaried person whose salary is 10 lakh rupees per annum, taxable salary. So the tax will be on this salary only 1,12,500 approx. Okay, as per the slab rate. And if he transfers this asset, then the tax will be 25 lakh rupees extra. So in capital gain, generally what happened, because we are talking about the capital asset, whether it's jewelry, whether it's land, building, etc. So gains are huge and the tax are huge in this case. So Assassi was very furious. Assassi was very disappointed. He was very sad. So Assassi was crying almost. He was crying that I need to pay this much of amount. And you can see generally what happens in case of building, land or capital asset when we transfer it. So we transfer because we generally want to buy a new one. If I transfer my old house, then what I will do? I will sell my old house, and generally what I will do might be going to purchase a new. For that purpose, we are transferring our asset. So generally it happens. Generally, I'm not saying it specifically in all cases, but practically you can think if somebody is transferring his land, then in that case he might be going to purchase another land. So government provides some investment scheme. Income tax say, do not cry. I am here to help you. Just do not cry. And income tax made some investment scheme in case of capital gain. That if you have a capital gain in previous year and you want to save it, then there we have made certain exemption under section 54. So these are exemptions, but these are technically investment based exemption. These are not exempted as children education allowance exemption. No, it is not house rent allowance exemption kind of. It is not like any other exemption. These exemption is on investment base. So section 54 is having some investment scheme. As section 54 says, if you purchase a residential house, then the investment in that residential house can claim as an exemption. Then we have 54B, that if you purchased a agricultural land, then you can claim exemption. For example, in this case, if Assassi purchased 120 lakh rupees new agricultural land, then section 54B will give the exemption if other conditions satisfied, and you just need to pay tax on 5 lakh. This is good. Even if land is for 130 lakh value purchased, then exemption for maximum 125 lakh can be claimed. So we cannot claim the exemption more than the income. So even if I invest 130, then the maximum exemption will be 125. And if we invest less than 125, that exemption can be claimed. So section 54 have an investment in residential property. If you invest, you can get the exemption under section 54. If you are buying a agricultural land, you can get the exemption section 54B. 54D say land and building for industrial undertaking. If you invest in factory purpose land and building, then you can claim exemption under section 54D. We have section 54EC. If you invest in specified bonds, which is notified by the government, then you can claim exemption under section 54EC. And the last is 54F. Again, it is for residential house. So residential house is covered under section 54 as well as 54F. There are certain conditions which will make you understand when section 54 will applicable and when section 54F will be applicable. But what I am just trying to convey, that if you are capital gain, then do not sad, do not disappointed. You need not to pay tax if you will invest as per section 54 exemption. So again, I am telling you, these are not actually the exemption like the agricultural income exemption we have or any other. These are exemption, but on the basis of certain investment. So you can technically invest your whole amount of capital gain. You can technically exempt your whole amount of capital gain if you invest in these exempted scheme and fulfill the condition which has been prescribed for these schemes. So understand what is exactly exemption? These are investment-based exemption. Moving on to the notes. So section 54 deal with the exemption scenario. So we have one specific exemption under section 1037, and after that we have the section 54 exemption format. So first of all, we are discussing section 1037. This is kind of agricultural exemption. So this is the real exemption. We can say this is the only real exemption under this exemption provision. All others are under section 54, technically investment-based exemption, but section 1037 is a specific exemption. And it says, now read it carefully. You might get confused. Any capital gain, whether it's long-term or short-term. Okay. So any capital gain, whether it's long-term or short-term. First important point. So this paragraph has multiple important points in this, in each sentence you can see. So first important was any long-term or short-term capital gain can be exempted. This exemption has been just given to an individual or HUF only. And if they are transferred agricultural land, now you might get confused that agricultural land in rural area is not a capital asset. So if that is not a capital asset, how can there be a capital gain? So we are not talking about the agricultural land in rural area. We are talking about the agricultural land in urban area. Okay. Exemption is for that. So if there is any kind of capital gain, long-term, short-term, assessee must be individual HUF. The property is agricultural land and it is transferred by way of compulsory acquisition. So if I have an agricultural land in urban area and I am transferring it, I am selling it to Mr. B, then this exemption will not work. This exemption will work only if you have an agricultural land, you are an individual HUF, and your agricultural land has been compulsory acquired. Under section 45, any other asset, any other capital asset, if have been compulsory acquired, that is not going to claim exemption under section 1037. Only if it is an agricultural land, then you can claim only the exemption under section 1037. Clear? Shall be exempt. Fifth important point, provided the OC or EC. We all know that OC or EC is received on or after 1st April 2004. So if the OC EC has been received on after 1st April 2004, and obviously in your examination, the date of OC EC will be given after 1st April 2004. So this is not that important point, but just explaining you before this date, it was not exempted. If such land has been used, this is also an important condition, is used for agricultural purpose for 2 years. So you have an agricultural land, but you did not use it for agricultural purpose, then this exemption will not work. So that agricultural land which has been used for agricultural or farming purpose from last 2 years, immediately the preceding date of transfer, compulsory acquisition. For example, if the compulsory acquisition took place on 2nd November 2022, then it's saying from last 2 years. That means from 3rd November 2020 till this date, it should be used for agricultural purpose. Before this time, not used for agricultural purpose, no problem. But in last to preceding year, it should be used for agricultural purpose. Clear? By such individual or his parents or by HUF. So the use must have been done by individual himself or his parents or HUF. So if he let out this land for the purpose of farming to someone else, he is doing farming from last 2 or 3 years, then property is compulsory required, then you cannot claim the exemption. Okay. So these 7.8, eighth important point in just 4 lines, but it's not yet done. Even capital asset, even compulsory acquisition. This is compulsory acquisition. So if compulsory acquisition is before 1/4/2004, but the compensation is received on or after this, it shall be exempted. So the OCEC receiving date should be on or after 1st April 2004. For example, in examination, examiner gives that the compulsory acquisition has been done in 2002, but the OC received in 2022. So is it exempted if other conditions satisfied section 1037? The answer is yes. So when the compulsory acquisition has been done, it does not make any difference. OCEC should be received on or after 1st April 2002. That was our 9th important point. So in a small paragraph, you have 9 important points. So for the purpose of exemption, you can learn like this. If there is any individual HUF, I am making it simpler for you. Any OC, EC received on compulsory acquisition on or after 1st April 2004 for compulsory acquisition. Okay. Use of agricultural land. Last 2 years used for agricultural purpose by individual, HUF or parents. Then capital gain exempt under section 1037. So you can read it or learn it like this. It will be simple for you to understand. So I just made a simple chart for you for understanding the concept of section 1037. So that is the real exemption what we have under capital gain topic under section 54 exemption. There is no other real exemption under section 54. They all are technically investment schemes. So now we are discussing these schemes one by one as per section 54. So what I am going to do, I am going to read the provision of section 54. And I believe you might not be able to understand it very easily. So first of all, we need to just read the provision and do not worry. I will explain you each provision. After section 54, we will read. I will explain you each provision with the help of example and chart also. So just relax and just read it carefully and just be with me. Just do what I say and you will find section 54, 54B, 54D, 54EC and 54F. These are easy. Okay. Okay, Madhav is asking, What if say land for payable to debts? I'm not getting your exact question, Madhav. You can ask me in detail. But it does not matter that if you are selling your any property to paying debt or for any other purpose. If there is a capital asset, there is transfer, it is going to be taxable. I've already told you the application of income does not affect the chargeability of it. Okay, so if there is a capital asset, there is a transfer and there is no exemption applicable as per the act or as per the provision, and it is going to be taxable. It does not matter you need to pay your medical bill, you need to pay your debt, you need to pay for any other purpose, that is irrelevant. Okay, Mr. Tiwari. Okay, section 54, and it says residential house transfer. So you can find in the heading, I have written in the heading that for the purpose of claiming exemption, what we need to transfer and what we need to purchase. So every section, every exemption has different criteria to claim it. So section 50 for exemption, you can claim only if there is a RHS residential house transfer. T is for transfer. So if I transfer a residential house, for example, I have a residential house, I transferred it for 50 lakh rupees. Clear? This is my sale consideration. And the index cost of acquisition, etc., everything is 35 lakhs. So now I have 15 lakh rupees capital gain. So if I transfer a residential house and I want to exempt this capital gain, then section 54 says buy a new residential house, then you can claim a exemption under section 54. So either buy a new residential house or construct it. So if these two conditions fulfill, like what I transfer a residential house. Suppose I transfer a land, okay, a piece of land I transfer, and I purchase a new residential house. Can I claim exemption under section 54? I transfer a land and the investment in residential house. So can I claim exemption under section 54? The answer is no. No, no. Because every section has a specific transfer asset and a specific purchase asset. So we should know that what should be transferred and what should be purchased to claim that specific exemption. Okay. So section 54 exemption can be claimed only if the transfer asset is residential house. Even if you are transferring your factory building office, you cannot claim exemption under section 54. The transfer asset should be residential house, and what we need to purchase, the investment should be in the residential house again. We need to purchase. P is stand for purchase and C is for construction. So if I am transferring a residential house, then for the purpose of claiming exemption, I need to invest also in a new residential house, whether purchase it or whether construct it. So I hope it's clear what to transfer, what to invest. This exemption is only available to individual and HUF because they only have family. HUF has family, individual has family. They only have the residential house. A partnership firm is an artificial person. They cannot have family like wife, son, daughters. So automatically this exemption when talks about residential house, that means whenever there is residential house involved, the assessee only can be individual and HUF. Company is an artificial person, they cannot claim it. So because exemption is for residential house, that is for only natural person. Those have family. It can be an individual only, and of course a Hindu undivided family. Understand? Why this is only for individual and HUF? You should not ask why. Okay, you should not ask why. But I just explained to you the concept why it is. But in examination, nobody will ask you ever why the provision is this. This is for your knowledge only. The asset should be long-term capital asset. Generally, we purchase residential houses for the purpose short-term or long-term. What is generally the intention? in case of purchasing a residential property. Generally, we purchase it for long-term purpose. So if I have a residential house and I transfer it and it's a short term, then I cannot claim the exemption. So we are talking about the transfer property. If I transfer a residential house, but it is a short-term capital asset, then this exemption is not applicable. This is applicable only in case of long-term capital asset. The transfer property should be long-term. Clear? Now the third point is very interesting. This is the point which has been inserted few years back, and it says it's a benefit point, and it says amount invested in one or two residential house. Like you transfer a residential house and you have a capital gain of suppose 15 lakh. Okay. Then you can also buy two properties. It is not mandatory that only one property need to be purchased. You can purchase property that is maximum two residential house exemption can be claimed. In some years back, it was only one property exemption was there. But now the department says you can invest even in one house property. That means you can purchase or construct one residential house. The amount will be claimed as exemption. And even you want, then you can purchase two residential house also. We will provide you the exemption. What is the exemption concept? I will tell you. After point number 3A, after point number 3, I will explain the provision as per the help of example, and then after remaining other points, we will solve another example of it. So point number 3 is very important for the purpose of examination, and it says investment can now in two houses in India. If the house is purchased outside India, you cannot claim the exemption for that house property. Okay. So investment can now in two houses in India if capital gain does not exceed 2 crore rupees. So if the capital gain, the property you transfer, the residential house you transfer, if the capital gain does not exceed 2 crore rupees, then to claim exemption, you can invest in two houses also. If you want to invest in one house, that is well and good. But you can also invest in two houses. For example, if your capital gain is 1.5 crore. So if you want to purchase a single house of 1 crore 40 lakh, you can claim the exemption of 1 crore 40 lakh. Out of that 1.5 crore, only 10 lakh will be taxable. Or even if you want, you can purchase a residential house for 100 lakh and another for 40 lakh also. So these two exemptions for the purpose of two residential house also can be claimed. I will explain you with the help of an example. Just relax. And two house exemption only can claim once. But the problem is this two houses exemption can be claimed only once in a lifetime. If you claim two houses exemption in any year, then in future you cannot claim this two house exemption. Now in future you can only claim one residential house exemption ever. If exemption claim for two house property in assessment year 23-24, then cannot claim two house exemption again in future. Only one house in a year can be exempt, even capital gain less than 2 crores. So this point number 8 is for those capital gain cases in which the capital gain does not exceed 2 crore rupees. And if the capital gain increase 2 crore rupees, then only one residential house exemption can be claimed. Let me tell you with the help of an example. Don't not worry. Now it says, for example, Mr. A sell his residential house for rupees 3 crore. Index cost of acquisition, index cost of improvement, etc. is 90 lakh. That means 0.90 crore. So he has a capital gain of 2.10 crore. Now section says, point 1, it is a residential house. First condition fulfilled. Mr. is an individual, condition has been fulfilled. That was a long-term capital gain, so this condition also fulfilled. Now to claim exemption, if Mr. A, situation 1, purchased a new residential house for rupees 3 crore, he can claim exemption 2.1 crore because the gain is exceeding 2 crore. So in this case, 2.10 crore will be exempted, taxable gain will be nil. Case 2 scenario, Mr. A purchased 2 new residential houses. One is for 1.6 crore, other is 1.8 crore. So can he claim exemption of both houses? The answer is no, because the gain has been exceeding 2 crore. Only one house can be claimed as exemption, that can be 1.8 crore. Balance will be your long-term capital gain, 30 lakh. Okay. Now suppose the capital gain was, suppose the capital gain is 1.70 crore. And now he purchased 2 houses. One is for 1 crore, other is for 80 lakh. Now in this scenario, both exemption can be claimed and gain will be nil. So if the capital gain increased 2 crore, only one house exemption can be claimed as per your benefit. So the amount which you invest maximum must be claimed. So in that case, your gain will be less. But if the capital gain is less than 2 crore, then you can avail the benefit of 2 residential houses. So now in third case, he can claim the benefit of 2 residential houses. I hope it's clear. I have a solved example also in the notes for this purpose. We can discuss it also. This is. So example 1, you can see assessment year 23-24, Mr. Ram long-term capital gain 180 lakh. Suppose he has a long-term capital gain of 180 lakh from transferring a residential house. Now Mr. Ram purchased three residential houses, 70 lakh, 80 lakh and 60 lakh. So because the gain is less than 2 crore, he can exempt any 2 residential house out of these 3. So he will take the highest value houses always. So he'll claim this 70 and this 80. His gain is 30 lakh. Example 2 regarding Mr. Raman, he has a long-term cap gain of 3.20 crore. That means 320 lakh. He also purchased 3 properties, but the problem is this: if you have more than 2 crore rupees capital gain, you can only claim 1 residential house exemption. So he can only claim 80 lakh. His capital gain will be 240 lakh. Now, in the future year, the example continues. Okay. Now, Mr. Ram, because Mr. Ram has already taken the exemption of 2 houses in 23-24. Mr. Ram now having in assessment year 27-28, he again having a long-term capital gain of 160 lakh and he purchased 3 residential house property. So that gain is less than 2 crore, but he has already claimed 2 house exemption in 23-24 assessment year. So this exemption only 1 can be claimed in the lifetime. So even he is fulfilling the condition 2 crore less than provision, but he can only claim 1 exemption because 2 residential house exemption already claim in 23 and 24. But Mr. Raman did not claim that exemption in earlier year because he is having a capital gain of more than 2 crore. Now in this year he is having a cap gain of 190 lakh. He can claim 2 house residential exemption because he did not claim it in earlier year. So 2 maximum value is 90 and 80 lakh. He can claim it and the long-term cap gain will be 20 lakh. So that was the concept of that point number C. Moving again to the section 54 provision. So point 1, we discussed that it is available only to individual HUF. The asset should be long-term capital asset. Third point was saying that investment in maximum 2 houses if your capital gain does not exceeding 2 crore. And this is only for one-time benefit of 2 house purchases. Otherwise, you can only claim 1 house exemption if turnover exceeding 2 crore. Now, the other condition says when to purchase the residential house property. When to purchase, whether purchase one or construct as your choice, but when to purchase 1/2. So it says the purchase within 1 year before the date of transfer. You can purchase these property for which you want to claim the exemption. And that can be purchased within 1 year before the date of transfer or purchased within 2 years after the date of transfer. You might get the difference between 2 points. First, say purchase within 1 year before the date of transfer. So if any property has been purchased within 1 year before the date of transfer, you can claim the exemption of that property. Or if you purchase property within 2 years after the date of transfer, even then you can claim the exemption. Or you can construct within 3 years after the date of transfer. So you have 3 options for claiming the exemption. Either purchase within 1 year before the date of transfer, or purchase within 2 years after the date of transfer, or construct within 3 years after the date of transfer. So construction benefit is not available before the date of transfer. So construction means construction completed within 3 years after the date of transfer. It is construction should be completed within 3 years after the date of transfer. With the help of example, I can explain it to you. So it says something like this, that if Mr. A transfer his residential house on 1st October 2022. Suppose the capital gain is 90 lakh. Now, to claim exemption under section 54, out of this 90 lakh capital gain, we need to purchase or construct new house property. Okay. What is the time duration to claim that house property? It is like this. It says purchase within 1 year from the date of transfer. This is our transfer date. So purchase within 1 year. Suppose the transfer date was 4th October. So it says within 1 year, that means 5th October 2021 till 4th October 2022. So if new property has been purchased within this year, for example, for 30 lakh rupees, you purchase the property between this duration for 30 lakh rupees, this is eligible for exemption. Any property purchased before this date, suppose it has been purchased in July 2021. So this is out of my exemption criteria. We cannot claim exemption of this property. We can claim exemption of this property out of this. Or you have 3 choices. If any property has been purchased within 2 years from the date of transfer, that means till 3rd of October 2000, within 2 years, 2000, that means 24. So if any new property is purchased after date of transfer, the time duration is within 2 years you need to purchase. For example, we purchase one new property for rupees 50 lakh after date of transfer, or say not 50, it's 60 lakh. Sorry, not 60, it should be 20 lakh. So this is also eligible for the purpose of exemption. So either you should purchase before within 1 year date of transfer, or you want to purchase, then the time duration is 2 years from the date of transfer. You have one more option left, that you can construction complete we are talking about. Constructed, it should be constructed. So you constructed a residential house if within 3 years from the date of transfer, that is also eligible for the purpose of exemption. So that means 3rd October 2025. So if we constructed a property before 3 years for 25 lakh rupees, so this house also eligible for exemption. Now we have a long-term capital gain was 90 lakh. Clear? And now we have eligible houses 3. This is not eligible. So we have removed it. We have 3 houses for the purpose of exemption. And because the gain is less than 2 crore, and we assume that assessee did not avail the 2 houses exemption earlier, then we can claim maximum 2 house exemption out of these 3. And which should be, one is this and one should be this. Only those houses will be taken, those have highest exemption can be claimed. So we will deduct 30 lakh and 25 lakh. To understand which houses can be claimed as exemption according to the time duration, if the any house property is purchased after 2024, 3rd October 24, we cannot claim the exemption of that house property. Suppose if I'll say that Mr. A already claimed 2 houses exemption benefit in earlier year, then only 1 house exemption can be claimed in this year, and that should be the highest value house, which is this 30 lakh. So if he did not claim the 2 house exemption earlier, then these exemption can be claimed. And if he already claimed 2 houses exemption in earlier year, then only 1 house exemption can be claimed. So the new purchase must be within 1 year before the date of transfer, or within 2 years after the date of transfer, or within 3 years construction should be completed after the date of transfer. So those property will fall in this zone. Those property will fall technically is this zone. Can be claimed at exemption. Depend upon the situation, 1 or 2, but you can claim exemption only those property, those fall in this 1, 2, 3 criteria. Okay, 1 year purchase, 2 year purchase, 3 year constructed. That was our point. So let me take the queries, then we'll move on to that. So that was condition number 4A condition, condition B, C, and 0.56 left for section 54. There's a good news that if we understand section 54 in detail and nicely, then almost 80% provision of other exemption like 54B, 54D, 54EC, 54F, almost 80% provisions are same. So our burden will be very less if we able to understand section 54 in detail. That's why I'm telling you section 54 with example. Every point I'm explaining with the help of example, because if you're able to understand this section 54, then the other 54, B, D, E, C, F, they are very, very simple, because almost 80 to 90% in such situation, the provisions are same. Let's take some query if possible. As per section 54, can we claim exemption in every year if such a transfer took place? Yes, you can claim exemption in every year. but the condition should be fulfilled. Like the transfer asset should be long term. It should not be short term. Suppose I have transferred my long term asset in previous year 22-23. I have a capital gain. I purchased a new house. Exemption claim. In next year, I want to sell that new house, what I have purchased. I want to sell that house and want to purchase another new house for exemption. So it is not possible because the asset I have purchased in 22-23 and claimed the exemption. And if I'll transfer it in next previous year, that will be a short-term capital asset. So exemption cannot be claimed. But you have 9-10 houses already, those are long-term. Then you can claim exemption in every year if you transfer them and purchase new property. There is no restriction about it. Okay. Okay, next is, sir, long-term capital gain is taxable in year of transfer. Then how can the SASI claim exemption if residential house is purchased or constructed after date of transfer? Good question. Very good question, Manish. I appreciate that. You are exactly going on the right thinking. Correct. The transfer will be in the year of, you can see that the transfer year in this case is 22-23. So we are going to chargeable the capital gain in assessment year 23-24. So this capital gain, what we just see, must be 90 lakh rupees in 23-24. And we are going to invest within 2-year purchase or within 3-year constructed. And that will be in future year. So how I will predict my future that yes, I will invest in purchasing house, so much amount 20 lakh, and I will invest in 25 lakh rupees in construction within 3 years. Because I need to claim exemption in this year only. But these will be happen in future. So we do not have a time machine. In the same case, section 45(5)(a), we do not have a time machine. So we cannot go back also. And we do not have a globe, that future globe we have in the movies. So we can see the future, what is going to happen. We do not have these kind of technology yet. So how we can claim the exemption for the investment, what we are going to do in future. For example, this has been purchased in 2023. House is purchased in constructed in 2025. So practically, this is going to happen in 2023 or later, or this will be happening in 2024 or later. So how this investment I can claim in current previous year? This is the question which Manisha is asking. That's a very good question. For this, government has made point number 5 and 6 in the exemption. Government says, if you want to purchase in future or you want to construct in future, then we have a capital gain deposit scheme. You deposit your capital gain amount in that. Do not actually construct or purchase. Do not do that. You can do it in later. You just invest your money, whatever you think you want to invest in purchase. At least you will tell us how much amount you want to use for purchase or construct. That amount you invest in this capital gain scheme in previous year, in assessment year 23-24 or before it. You deposit money in that amount and we will give exemption on the basis of just that deposit. You invest in that scheme, we will provide you exemption in current year only. We will assume that you will use that money in future for the purpose of purchase and construct. So government will trust you that if you invest in that money in that capital gain scheme, we will provide you exemption in current year only, assuming that you will use that money in future for the purpose of purchase and construct. So now your next question will be, sir, what will happen if he did not use it? Or if he used it for some other purpose? Do not worry. We have provision for that also. So that is going to come in this section. So Manisha asked me the question earlier, but if you would have been waited for completion of point number 5A, B, C, and 4, 5, 6, then your answer, all queries answer regarding that what will happen if he did not use, how to utilize that money in current year, what is the capital gain scheme. I was about to discuss, but because Manisha asked, so I will explain you. Do not worry. We will discuss these points also. So point number 5 and 6 will discuss about it, that how we can get the exemption is this year in the previous year, even when I am going to purchase the property in future. And what will happen if I am not purchasing it? That is also scenario will be discussed over it. So that is Manisha question. You will get your all answer when we will complete section 54 table. Okay. Purchase 1 and 2 are which type of property? Constructed or land? Constructed means the residential house purpose. If you only purchase land and did not construct it, that is not residential house. You cannot get the exemption. Okay. And the purchase property is residential house. Building. There should be building. It should be a residential house. Aisha is asking something. Sir, if an individual is also part of the HUF, purchase a residential house separate from that of the HUF, will this provision apply to him? It depends what property you sell. If the property is sold by the individual in his personal capacity, only against that property you can claim the exemption. So if HUF transfer a property and capital gain arise to HUF, then if individual purchase for his personal purpose, he cannot claim that exemption out of the capital gain of HUF. Okay. Bhumika, sir, future investment or purchase shall be deemed purchase or investment? Yes, very well done. We understood. Even I have not explained the provision in detail because that will going to be discussed after the tea break. But still, you students understanding the provision, even with the help of the small explanation I have just given, that is really commendable. Very well done, Bhumika. Exactly, you just understood the correct thing. That you invest in the scheme that will be taken by government as a deemed investment. So do not worry. That topic we will consider after the tea break. Just relax, enjoy till what we just discussed. Welcome back, dear students. And as usual, I have my tea. I believe you must have your tea, coffee, etc. So, as we all know, that we have now we have our story time. No more query. Okay, somebody has asked that if individual is the owner of two house property and both house property are under construction, can such individual claim exemption? No. The house should be completed within 3 years from the date of transfer. Until otherwise it is completed, you cannot claim the exemption. The construction should be completed. Okay. So, story time, and let's see if somebody is interested to hear the story. So, if you are ready to study, listen the story, kindly send that who are ready to listen it. Then only I'll explain you a very small 2-minute story. So, Bhumika is saying, okay, sir, for a query. So, how many of you are interested in the story part? Then we will move on to our provisions of section 54. So, if nobody is interested, then we are skip our story today. Okay, Bhumika is saying, of course, sir. Only Bhumika is interested. So, I guess we should skip the story part today and we should move on to our notes directly. So, what we were discussing was section 54. So, except Bhumika, nobody is interested. Okay, so assessee should be individual. Okay, query Singh, Rajiv Kumar interested. Aisha is also interested. Okay, Krati is also interested. Okay, fine. If you are interested, then I am much more interested. Let's get back to our story time. Might be आप लोगों में से कुछ लोगों ने शायद स्टोरी सुनी भी हो, बट ये काफी impactful, we can say, inspirational और मोटिवेशनल काइंड ऑफ स्टोरी है. छोटी सी स्टोरी है और माइट भी कुछ लोगों को याद भी होगा, बचपन में आप लोगों ने शायद पढ़ी. तो था क्या, एक बच्चा था, छोटा बच्चा, स्कूल जाता था एंड वो काफी स्कूल में अपने टीचर्स से डांट था बिकॉज ही वॉज नॉट दैट स्मार्ट टू कोप अप विद द स्कूल एनवायरमेंट. उसको चीजें ठीक से समझ नहीं आती थी. सो लाइक डिस्लेक्सिया, लाइक तारे जमी बटाई, स्पेशल टाइम काइंड ऑफ पर्सन. सो वो जो बच्चा था उसको स्कूल में हमेशा डांट पड़ती थी, टीचर से डांटते थे, उसे चीजें समझ नहीं आती थी तो टीचर उसको बोलते थे कि तुम नहीं पढ़ सकते हो, एक्सेट्रा एक्सेट्रा. और वो रोज घर आके अपनी मम्मी को बताता था कि आज मुझे टीचर ने ये बोला, वो कहते हैं तुम्हें पढ़ना अच्छी तरह नहीं आता, हम तुम्हें पढ़ा नहीं सकते बिकॉज यू आर नॉट दैट स्मार्ट, तुम्हारा IQ लेवल बहुत कम है, सो एंड सो एंड सो. तो जब काफी टाइम हो गया तो स्कूल वालों ने एक लेटर दिया उस बच्चे को स्कूल में और कहा ये अपनी मम्मी को दे दो. तो वो घर आया, उसने कहा मम्मी मुझे स्कूल से लेटर मिला है. उन्होंने कहा आपके लिए. उसकी मामा ने लेटर पढ़ा और लेटर पढ़ने के बाद शी वाज स्टार्ट क्राइंग. तो उसने पूछा कि आप क्यों रो रहे हो, लेटर में क्या लिखा है. उन्होंने कहा उन्होंने लेटर में लिखा है कि आपका जो बच्चा है वो बहुत होशियार है और इस वजह से हम उसे डांटते रहते हैं क्योंकि हम उसके क्वेश्चंस को सॉल्व नहीं कर पाते और क्लास के बाकी बच्चों को काफी इंफीरियरिटी कॉम्प्लेक्स होता है, उन्हें काफी बुरा लगता है क्योंकि ये उन सबसे ज्यादा होशियार है. तो प्लीज आप इसे किसी और अच्छे स्कूल में डालिए जो हमसे अच्छा हो, या इसे घर पर बैठ के पढ़ाइए. तो उस टाइम में स्कूल बहुत ज्यादा होते नहीं थे, वही एक स्कूल था, बाकी स्कूल्स तो फिर बहुत दूर वगैरह थे. तो उसकी मम्मा ने उसको गले लगाया, हक किया, उसको बोला कि तुम इतने होशियार हो, इतने होशियार हो, मुझे सोचकर ही रोना आ गया कि स्कूल तुम्हें नहीं पढ़ा पा रहा, तो अब मैं तुम्हें पढ़ा. उन्होंने स्कूल से उसे हटाया और उसकी मम्मी ने उसे पढ़ाना शुरू किया. पढ़ते रहे पढ़ते रहे पढ़ते रहे और एक टाइम के बाद वो एक साइंटिस्ट बन गई. और उनकी मम्मी एक्सपायर हो गई, तब वो उनका सामान सारा ढूंढ रहे थे और सामान में वो पुराना लेटर उन्हें मिला रखा हुआ उनकी मम्मी के बॉक्स में. जब लेटर पढ़ा तो उसमें एग्जैक्टली क्या लिखा हुआ था, स्कूल वालों ने लिखा था कि आपका बेटा बहुत डम है, इसका पढ़ने में कोई इंटरेस्ट नहीं, ये एवरेज स्टूडेंट से भी बिलो है, हम इसे नहीं पढ़ा सकते, हम इतने बेवकूफ बच्चे को नहीं पढ़ा सकते, तो कृपया आप इसे घर पर रखें और खुद पढ़ें। सो ही स्टार्ट क्राइंग बिकॉज उसकी मम्मी ने उसे रियलिटी जो उस टाइम थी लिखी हुई वो नहीं बताई थी, बिकॉज शी ट्रस्टेड, शी हैज अ फेथ ऑन हर सन कि ये वैसा नहीं है जैसा स्कूल वाले सोचते हैं। एंड सिर्फ उसकी मदर ने उस पर ट्रस्ट किया। एंड इमेजिन, वो बच्चा सच में बचपन में होशियार नहीं था, बट बिकॉज हर मदर हिज मदर टोल्ड टू हिम दैट, स्कूल वाले कहते हैं कि तुम बहुत होशियार, एक्सट्रीमली इंटेलिजेंट। तो उस बच्चे में वो कॉन्फिडेंस आया जो उसे स्कूल में नहीं मिलता था। वहां सब लोग उसे डांटते रहते थे कि स्कूल मुझे बहुत होशियार समझता है, वेरी स्मार्ट, वेरी इंटेलिजेंट, दैट्स व्हाई उन्होंने मुझे स्कूल से निकाला है। तो मैं सच में इतना होशियार हूं कि अब मेरी मम्मी मुझे पढ़ाएंगी एंड आई विल डू दैट। तो वो जो कॉन्फिडेंस, वो जो मोटिवेशन उनकी मदर ने उसे दिया, सिर्फ विद द हेल्प ऑफ दैट मोटिवेशन ही बिकेम सच अ बिग साइंटिस्ट। एंड आई गेस आप में से कुछ लोग उनका नाम जानते। इट्स अ रियल स्टोरी, राइट? इट्स अ रियल स्टोरी एंड इट्स ट्रुथ। और उन साइंटिस्ट का नाम शायद आप में से काफी लोग जानते भी हो। बट द मोरल ऑफ द स्टोरी इज कि अगर उस दिन उनकी मम्मी ने वो लेटर पढ़कर उन्हें डांटा होगा, स्कूल तो वैसे भी नहीं भेजना था, मान लीजिए डांटा गया होता, उनको मारा गया होता या उन्हें ह्यूमिलेट किया गया होता, तो शायद उसका कॉन्फिडेंस हमेशा के लिए खत्म हो जाए। तो इवन वो बच्चा जो पढ़ाई में अच्छा नहीं था, बट करेक्ट गाइडेंस, करेक्ट मोटिवेशन से he just did the wonders. He was Thomas Edison who invented the electricity bulb. So this is the real story of that, and I believe आप में से कुछ लोगों ने पढ़ा भी होगा, I guess. So आप सोचिए कि एक सही मोटिवेशन और किसी का सही बिलीव, हम सबके पास उतना ही ब्रेन है जो किसी और के पास है, उतने ही होशियार है। It just depends कि where we invest our time, where we invest our brain, in WhatsApp, Instagram, etc., or in study or in our future. So it just depended. After that motivation of mother, उसको अपने ऊपर कॉन्फिडेंस आया और मदर को तो कॉन्फिडेंस आया, and he just became a huge scientist, Mr. Thomas Edison. So this was a real inspirational story. And I believe that's true. So sometime कभी आपको ऐसा लगता है कि आपसे नहीं हो पा रहा है etc., तो just believe yourself, होगा। अगर किसी और से हो सकता है तो आप भी कर सकते हो, हम सब लोग उतने होते हैं। That was the story and the part 4th of our rabbit and tortoise story. Part 1 में tortoise जीता था, तो rabbit को समझ आया कि ओवर कॉन्फिडेंस नहीं होना चाहिए, और tortoise को समझ आया कि अपना बेस्ट दो और फिर destiny can help you. Second race में rabbit जीता because he learned from her mistakes. And then moving on to our next part, what we were discussing in the last session, section 54. This story will continue at the end of this session because I need to complete section 54 section, so we will be connected to our section 54 provision. Okay. So under section 54, there was assessee who was individual and HUF. Time period held was long-term asset. Amount of exemption is very, very important. Let me tell you, this is one of the most important exemption, section 54, in which the amount of exemption says that you can claim the exemption either for one residential house or two residential house. It depends. If your capital gain is up to 2 crore rupees, then you can get exemption for two residential house, but only once in a lifetime. And if your capital gain increase more than 2 crore, then you can only avail one residential house exemption. We discussed that. Then condition we discussed that new house property should be purchased or constructed under a specified time period within India. And that is purchased within 1 year before the date of transfer, purchased within 2 years after the date of transfer, and construct within 3 years after the date of transfer. And as I have explained you, construction should be completed within 3 years. Then only you can claim the exemption. So till here, we discussed the provision. Now the situation arises. The point B say a new provision, and it says the newly acquired house property, the house property for which we claim the exemption, whether we purchased it or constructed, the newly acquired house property should not be transferred within 3 years after its purchase or construction completed. So this point number B explained that if you claimed exemption from section 54 in respect of any property which has been purchased or constructed, as the case may be, that property should not be transferred within 3 years after its purchase or constructed. Now the question arises, what if we have transferred it? So if you transferred that new property for which you have claimed the exemption under section 54 before expiry of 3 years, then the cost of the new asset, on sale will be reduced by the amount of capital gain exempted earlier. So point number B and C, I am explaining you with the help of an example. So you will be understand it clearly. So provision says, for example, Mr. A having a long-term capital gain on selling of a residential house for rupees 90 lakh. Suppose he purchased new residential house for rupees 70 lakh. So that has a exemption under section 54 if other conditions has been fulfilled. 20 lakh rupees is long-term capital gain for assessment year 23-24. Now the provision says this new property should not be transferred. This new property should not be transferred within 3 years. And if it is being transferred, for example, this new property has been sold out by Mr. A in next year, that is assessment year 24-25. This house has been sold for rupees, say 95 lakh. Now the period of holding, only 1 year, that is short-term capital asset. Now the sale consideration is 95 lakh. Now the concept says that if new property for which exemption has been claimed has been transferred before expiry of 3 years, then the cost of acquisition, what will be the cost of acquisition? There will be no indexation because it's a short-term capital asset. So what were the cost of acquisition? That was 70 lakh. The cost of exemption will be reduced by the amount of capital gain exempted earlier. So how much exemption we claimed due to this residential house? That was 70 lakh. So the cost will be reduced with the amount of exemption. So now the cost will be 0 and 95 lakh will be my short-term capital gain. So if you transfer this property technically, then what will happen? Your exemption will be removed. And what is the way to remove this exemption? Your cost will be reduced by the amount of exemption. So automatically your 70 lakh benefit, what you have claimed in earlier year, has been gone. Because if this has not been gone, then your cost will be 70 lakh. Your gain will be only 25 lakh. Now you can see your gain is 95 lakh. That is 70 lakh gain increased. And why it is increased? Just because if you transfer the property before expiry of 3 years, your exemption will be reacquired by the government technically by reducing this exemption amount from the cost of acquisition. Suppose if the long-term capital gain was 90 lakh, but new residential house has been purchased for 98 lakh, then exemption maximum 90 lakh can be claimed under section 54. So our cost cap gain will be nil. And this has been sold for 105 lakh in next year only. So again, short-term capital asset, your sale consideration will be 105 less cost of acquisition was 98 lakh. You should not think that it always comes 0. No, it will always come 0 if the purchase price and the exemption is same. But in the above example, you can say I have invested 98 lakh for purchase of new property, but exemption was not 98 because the gain was 90 lakh. Maximum exemption can be claimed 90. So now 90 has been reduced out of my cost of acquisition. 8 lakh will be my cost of acquisition for calculating capital gain, which will be 97 lakh. So it is very important to understand that if you claim exemption for any new residential house under section 54, that property should be with you for at least 3 years. If it has been transferred, then the capital gain exempted earlier will be reduced from the cost of the new asset sold. So now we are again reading point number B and C, and you will understand it now completely. Point B says newly acquired house property should not be transferred within 3 years after its purchase or construction. And if newly acquired house property transferred within 3 years, the cost of new asset on sale will be reduced by the amount of capital gain exempted earlier. Now, point number 5 and 6, that was a question asked by, I guess, Bhumika or someone, that how can we claim the exemption in the previous year when we are going to invest in the property for in future purchase or investment. So here is the magic behind it, which is made by the income tax department for providing you the exemption in the same year in which the capital gain arise, even when the investment will be in the future year. So now the provision says that up to due date of, and this concept is applicable in almost all the exemption except section 54 EC, up to due date of ROI, that is 31st July 2023 or 31st October 2023, depending upon the person wise. So up to the due date of ROI, if you want to claim exemption, you have two options. You have two options that up to the due date of ROI, either do the actual purchase up to the date of ROI, either do the actual purchase. For example, our long-term capital gain for assessment year 23-24, suppose was 80 lakh rupees. And we need an exemption. So provision says if you need exemption under section 54, etc. This provision is applicable on 54, 54D, 54B, 54F, not applicable on 54 EC. So if you need to claim exemption, for example, you want to claim 70 lakh rupees exemption for purchase of residential house. You did not purchase it yet, but you want to exempt your 70 lakh rupees for this purpose. Then department says you have two options. Up to the due date of ROI, you have to excise one of it. Option 1 says either actual investment in purchase of residential house. Up to due date of ROI, if you purchased new residential house, purchase or construct 70 lakh rupees, as the case may be, purchase or construction completed. So if you actually purchase or invested up to due date of ROI, then you can claim exemption, of course. In assessment year 23-24 calculation, your gain is 80, your exemption will be 70, 10 lakh will be your gain. So if you able to invest actually or able to constructed your completion of property up to due date of ROI, you can claim the exemption, but practically it generally does not happen, because if you are going to purchase a property, it might take time. You might be able to purchase after 1 year. And if we need to actual investment, if we have to do the actual investment up to due date of ROI, then what is the purpose of that 2-year time duration or 3-year purpose? Because that days will occur after the due date of ROI. So if government wants you to actual purchase up to due date of ROI, then the time limit for 2 year after the date of transfer and 3 year is irrelevant. It looks like it, but no. That benefit can be claimed as per option B. If somebody is saying that I am not going to purchase the property now, I want to purchase my property after within 2 years or going to construct the property within 3 years, then you can do this thing to claim the exemption in the same previous year. It says actual purchase or deposit. Whatever amount exemption you need, whatever amount exemption you want, you need to deposit that amount in capital gain deposit scheme account. This is in bank, so you need to go to the bank and ask them to open the capital gain deposit scheme account. So you have to do this up to due date of ROI. For example, Mr. A invests 70 lakh rupees in capital gain deposit scheme up to the due date of ROI. If this has been done, department will deem that you have technically invest 70 lakh rupees in purchase or construction of property. So on the basis of your just investment, what will happen in assessment year 23-24 calculation? You have long-term capital gain 80 lakh. And if you invested, then exemption under section 54, 70 lakh will be available to you. Your gain will be only 10 lakh. If you invest 90 lakh rupees, then full amount will be exempted up to rupees 80 lakh. So suppose he invested in capital gain scheme 70 lakh rupees. So exemption will be available, deeming that assessee is invested in purchase or construction of a property. Now you have option to use this money which has been deposited in the account within 2 years. If you want to purchase that amount property within 2 years. If you want to construct, then within 3 years you have to construction completion of that property. So either you have to do this, then your exemption already has been availed. So if you are doing purchase, if you are complying this condition or this condition, no further treatment in the future year. In the year you purchased or in the year construction completed, no action need to be taken under capital gain because you claim the benefit deeming that you have already purchased or deeming that you have already constructed. So even after that, within time you have done that, there will be no special provision in that year. But the problem is this. If this has not been done, what happened? If you used it, then no further treatment because the treatment we have already done deeming that you have already purchased or constructed. But what if you did not utilize or misutilize? This money was only for purchase or construction of house, and you deposit that amount in the bank only for that purpose. So if somebody is using that money for any other purpose, like for purchasing of car, jewelry, etc., then what will happen? Or the other case will be, if 2 years has been elapsed and you did not purchase anything, and 3 years also has been elapsed and you did not constructed anything, or the construction has not been completed. That's called unutilized. So there will be 3 situations. Either you used it for the purpose as you promised. In that case, there is no treatment required because treatment has already been done in assessment year 23-24. But if the amount is misutilized, for example, this 70 lakh has been utilized or any part of it, then it will be deemed as capital gain in the year of misutilization. In the year of misutilization, it will be treated as your long-term capital gain. For example, if out of 70 lakh, 50 lakh has been utilized for the purpose of purchase of property and only 20 lakh has been misutilized, then 20 lakh is going to be taxable as long-term capital gain in the year of misuse. Of that 70 lakh, 60 lakh has been utilized for the purpose of purchasing a property within time. And 10 lakhs has remained in that account and 3 years has been expired. So that 10 lakh is going to be taxable in the year in which 3 years has been expired. Or if there's some misutilized amount, that is going to be taxable in the year of misutilization. So it's very simple. So now you understood, either we have to go for the actual purchase or actual investment, then you can claim exemption in the assessment year 23-24, or you need to deposit your amount in the capital gain deposit scheme. Then you can claim the exemption in 23-24. But there will be 3 scenarios after that scheme investment. Either you used it for the purpose you set it, then there will be no treatment. If it is utilized or unutilized, then that amount is going to be taxable as long-term capital gain in the year of misutilization or 3 years has been expired. Moving on to the provision in point number 5.6. Point number 5 says, if amount not utilized before the due date of ROI for acquisition of house property, it can be deposited with the nationalized bank in capital gain deposit scheme. So up to due date of ROI, you have to deposit in that scheme if you are not going to actually invest the amount. You can do this also, that out of 70 lakh, you used 40 lakh rupees and remaining 30 lakh, you are going to deposit in a scheme. Even in that case, 70 lakh is going to be exempted. But whatever you want to do it up to the due date of ROI. If due date of ROI has been passed on, after that, any amount deposited in scheme or actual investment will not be eligible for the purpose of exemption. If deposited amount not utilized within the time limit, unutilized or misutilized amount should be taxable as original gain. That means original gain was long-term gain, so it will be long-term cap gain in the year in which 3 years expire or in the year of misutilization. So that was section 54. And if you are able to understand the concept of 54, let me tell you students, the other sections are almost the copy-paste provision, almost. I'm not saying everything, but almost 70 to 75%. It is similar concept. There's nothing new. They all are just like section 54. So 54 has the main character, and that was transfer should be a residential house and purchase or construct a new residential house. Now the same case, section 54B. And now it says that transfer asset should be agricultural land and purchase should be again a new agricultural land. Why we are saying only purchase, not constructed? Because we are talking about land investment scheme. If we are construct, that will be a building. So if you transferred your agricultural land and out of the money you invested in a new agricultural land purchase, you can have the exemption of section 54B. For the purpose of clarification, let me tell you, this agricultural land must be in urban area, not rural. Rural are not capital assets. So there is no need of capital gain exemption if it is a rural asset, right? And purchase agricultural land can be either urban or rural. So purchase can be anyone, but the transfer should be agricultural land in urban area. Section 1037 we also discussed. Might be you get confused that we just got an exemption for agricultural land. We just read it over here that agricultural lands are exempted, but no, that is agricultural land in urban area if compulsory acquired. Then section 1037 exemption comes into the force. There must be an agricultural land in urban area, but the main thing is compulsory acquired. And in this section 54B, the agricultural land is transferring. That means not compulsory acquired. We are either sale, exchange, relinquishment, etc. Except compulsory acquisition. Because if there's a compulsory acquisition, then section 1037 might come into the force. So if you have an agricultural land and you are transferring it by sale, etc., and if out of that capital gain you are purchasing agricultural land, then exemption can be claimed under section 54B. So you can see section 54 applicable when there is residential house transfer and residential house purchase or construct. In the same way, 54B say agricultural land in urban area should transfer and agricultural land purchase in urban area or rural area, you can get the exemption. Again, assessee is same as per section 54, individual HUF. But asset can be anyone, long term or short term does not matter. In this case, it was long term, over here is long term or short term. Amount of exemption, that is amount invested in agricultural land. The condition says, conditions are very simple, not that complicated as per section 54. Conditions are very simple. It's a agricultural land situated in urban area. We are talking about the agricultural land situated in urban area was used by assessee or his parents or HUF for a period of 2 years prior to the date of transfer for agricultural purpose. This kind of condition was also in section 1037, that the land should be used for agricultural purpose for last preceding 2 years. Purchase new agricultural land in urban or rural area and purchase time period is 2 years after the date of transfer. As in residential house case section 54, there was 1 year before, 2 years after, 3 years for construction. In section 54B, there is only one time duration, that is purchase within 2 years after the date of transfer. Now the interesting thing, point B and C and 5 and 6, same as per section 54. You can see newly acquired agricultural land should not get transferred within 3 years after its purchase or construction. So construction word is wrong. It's only purchase. Okay. Newly acquired property, if transferred within 3 years, the concept same applicable, that the cost of acquisition will be reduced by the amount of capital gain exempted earlier. Point number 5 is also same, that either you have to purchase new agricultural land up to the due date of ROI, and if not, you can invest in capital gain scheme, and that amount will be deemed as your actual investment. What if the amount has not been utilized or misutilized? The misutilized amount is going to be taxable in the misutilization year, but if it is unutilized, then it is taxable after expiry of 2 years. In which year? 2 year expire. In this case, it was 3 years. Why? Because section 54 has investment time limit for 3 years. So unutilized will be taxable in the expiry of 3rd year. Section 54B only have time duration for 2 years. So that is going to be taxable in the year in which 2 years expire. So you can see, because we just understood section 54 in detail with example one by one. So now section 54B seems very easy for us. There is only 2-3 conditions you need to understand. That is, what should transfer? Agricultural land, urban area. What should purchase? Agricultural land, wherever it is situated. Individual HUF can claim this exemption, long term, short term. How much amount you invest, you can claim exemption. Condition, the agricultural land should be used for 2 years, purchase within 2 years. All other conditions are same. Copy, paste. Now 54D. 54D talks about compulsory acquisition of land and building forming part of industrial undertaking. So if there is any compulsory acquisition, now understand this carefully. When we talk about section 54, it says residential house transfer. That means exemption can be claimed if residential house transfers. Transfer can be sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of stock and trade, etc. All cases involved under section 54, exemption. Same in case of agricultural land transfer. That means it can be sale, exchange, relinquishment, etc. except compulsory acquisition, because in that case, section 1037 comes. But section 54D only talks about only one kind of transfer, and that is via compulsory acquisition. If government compulsory acquired your land and building forming part of industrial undertaking, In short, we are talking about factory. Industrial means manufacturing unit. So if government, you have a factory and government say we are going to compulsory acquire it under section 45(5) provision for any purpose of construction of road, highway, etc., airport, whatever it is. So if your factory has been compulsory acquired by the government, in that case, you can claim exemption under section 54D only. Listen carefully. If I have a factory and I am going to sell it to Mr. B and get the compensation, in that case, section 54D exemption not available. It is available only if your factory goes into compulsory acquisition. In section 54, 54B, everything is covered, whatever is the definition of transfer, sale, exchange, etc. But for 54D, only one transfer case you can claim the exemption, and it should be compulsory acquisition of land and building forming part of industrial undertaking. That means if your factory has been acquired by the government under compulsory acquisition, so that is going to be transfer. And what you need to purchase or construct new land and building for industrial purpose. That means if you invest in for new factory land and building, you can claim exemption under section 54D. So if your factory has been acquired by government for compulsory acquisition, and if you are going to purchase out of the compensation you receive, OC or EC, new factory land and building, then that exemption can be claimed under section 54D. Clear? Assessee is all person, individual, HUF, AOP, BOI, LLP, firm, company, anyone can be an assessee. Benefit is available to universally all. Whenever there is residential house or whenever there is land, only individual HUF include. In other cases, always all assessee can claim the exemptions. Time period, whatever it is, long-term, short-term factory, does not matter, you can claim the exemption. Amount invested in new land and building for industrial purpose. Whatever amount new land and building you will purchase or construct, that is your exemption amount. Condition is same, just like agricultural land. Industrial land and building was used by SSC for a period of 2 years prior to the date of transfer for business purpose. Purchase new land and building for industrial purpose, purchase or construct. Over here, construction is also included because we are talking about building. So whenever there is building, construction automatically includes. So you have to purchase or construct within 3 years after the date of compulsory acquisition. So you have to purchase or construct within 3 years after the date of compulsory acquisition. And only these conditions fulfill, you can claim the exemption. The rest provisions are same. B says new land and building, you should not transfer within 3 years after its purchase or construction completed. If it has been done, if you transfer it before 3 years, then the cost of acquisition will be reduced by the amount of capital gain exempted earlier. Same concept applicable. If amount not utilized, then you have to deposit in the capital gain scheme. Same provision. If it is misutilized, it will be taxable in the year of misutilization. If it is unutilized, then it's going to be taxable after expiry of again. In this case, how many years? 3 years, because the investment time duration is maximum 3 years. So in first exemption, because the time was 3 years investment, 3 years after taxability. In second, 2 years was. So after expiry of 2 years, it's taxable. And again, in 54D, the 3-year concept came. So unutilized amount will be taxable in the year 3-year expires. That was section 54D. So now you can see one thing, the common thing in all 3 sections, whatever we are transferring, technically we have to purchase the same thing for the purpose of exemption. Section 54 say you are transferring residential house, so you have to purchase residential house. Agricultural land you are transferring under section 54B, so you have to purchase agricultural land. You are transferring 54D, your asset compulsory acquired. What is the asset? Land and building of a factory. And what is the exemption? If you have purchased new land and building or constructed. So till now, whatever you are transferring and whatever you are purchasing is same. But now the things are going to change. Now section 54 EC and 54F, you are transferring something else and you are going to invest in some other property. Section 54 EC now say any land and building or both long-term capital asset transfer. So now you have to transfer either land or building or both, but that should be long-term capital asset. And out of that, now investment should be in a specified long-term capital asset purchase. These are specified bonds and debenture notified by the government. Which bonds and debenture has been notified, has been written in the provision. So in this situation, you can see we can transfer land and building or both, but that should be long-term capital asset. And we have to purchase something else. What we are purchasing technically is specified asset, that is specified securities. And a new thing also in this section is here. These are specified bonds and debenture notified over here. The maximum exemption can be claimed up to rupees only 50 lakh. So if you have a capital gain of 80 lakh and you want, if you purchase government bonds and debenture for rupees 80 lakh, then this section will only give you maximum 50 lakh rupees exemption, not more than that. So after section 54 EC, I will take your queries if there is any query. So assessee is all assessee. I already told you in case of only residential house and agricultural land, it's individual HUF. Otherwise, in all other cases, all assessees are involved. So assessee, all assessee, time period already mentioned in the provision. It should be a long-term capital asset. So time period is long-term, land, building or both. Amount of exemption. Amount invested in long-term, NHAI, RECL, etc. or any other notified bonds who is redeemable after 5 years. It cannot be who. Those are redeemable. So invested in long-term, NHAI full form has been written, National Highway Authority of India, and RECL is Rural Electrification Corporation Limited. Has been notified down, do not worry. So if you invest in these specified bonds, those are redeemable after 5 years. Then you can claim exemption, and that is maximum up to 50 lakh. Condition, assessee has within a period of 6 months. Investment time duration is only 6 months from the date of transfer. Here is no time duration like 2 years, 3 years before. No, it's just a single time duration fixed. Assessee has to invest within 6 months from the date of transfer. Invest in long-term specified asset. Long-term specified asset means any bonds or debenture redeemable after 5 years of issue, that is NHAI and RECL, redeemable after 5 years. Full form are over here, National Highway Authority of India, Rural Electrification Corporation Limited. Now in last 3 sections, the property should not be transferred within 3 years. In section 54 EC, the time limit is 5 years. Because in earlier also it has been written, the redemption should be after 5 years. So newly acquired property or asset should not be transferred or converted into money within 5 years after its purchase. Converted into money means you cannot even take loan against it. You cannot transfer it, even you cannot take loan against these bonds. If you've done this, then your exemption will lapse. So newly acquired property cannot be transferred or converted into money within 5 years after its acquisition. And a C point is again same, but have a slight difference. If newly acquired property or asset transfer within 5 years, in earlier provision, section 54, 54B and 54D, if you transfer the property within 3 years, then what happened? The capital gain exempted earlier will be reduced from the cost of acquisition of that property. This is not going to happen over here. In section 54 EC, if you transfer the property within 5 years, then the exempted amount earlier is going to be taxable as long-term capital gain in the year of transfer. That is going to be taxable as the normal gain. There was a long-term capital gain. It is going to be taxable in the year of transfer. So there is no reduction from the cost of the asset. No reduction. There is no reduction from the cost. Cost will remain the same, but the capital gain exempted earlier, the same nature of cap gain is going to be taxable in the year of transfer. Let me show you the difference between those two provision one by one. So now you can see that transfer within 3/5 years implication. For example, there is a long-term capital gain in the hands of Mr. A 90 lakh. Okay. Now assume he purchased a residential house for 80 lakh. All other condition has been satisfied. He will get a exemption of 80 lakh, 10 lakh is his capital gain. Now he transfer this in the next year. Within a year, he transferred this property. Sale consideration was 105 lakh. So section 54B and 54D having same implication on transfer of asset within a certain time period. But 54EC and 54F, what we will be discussing after section 54EC, having same implication. So these three having the same implication regarding it, and these two having the same implication regarding it. So if this happen under section 54, 54B or 54D, then the concept says what we will do, the cost of acquisition is going to be reduced with the amount of exemption earlier. So the cost of acquisition will be 0. So my capital gain will be 105 lakh. Taking the same example is not fine. We can take this. It says, suppose long-term capital gain was 90 lakh. You invest in NHAI bonds, rupees 80 lakh, but maximum exemption can be claimed, of course, 50 lakh. So 40 lakh will be the long-term capital gain of this year, as this was the long-term capital gain. Now, it should not be transferred till 5 years, but in next year we sold it and the sale consideration was 105 lakh. Now the concept says under section 54 EC exemption or 54F, we do not change the cost. So cost will remain 80 lakh. So that means 25 lakh will be my gain. And it says separately that whatever will be the amount exempted earlier, whatever was the amount exempted earlier is going to be taxable again. So this 50 lakh is going to be taxable again. So this is my taxable capital gain. And the amount exempted earlier is going to be taxable again. So we are not going to reduce anything from the cost of acquisition in case of section 54 EC and 54F. We reduce the normal cost of acquisition for the purchase of that property, and what amount has been exempted earlier is going to be taxable again. Taking one more example. Because I want the exemption should be same, but the limit was 50 lakhs. So taking another example, suppose the capital gain was 40 lakh and new residential house purchase under section 54 for rupees 35 lakh. This 35 lakh has been exempted. So over here, 5 lakh is my long-term capital gain taxable. This should not be transferred within 3 years, but we transfer in the next year. And sale consideration for this residential house was 60 lakh. So section 54, 54B and 54D, the same concept plays. It says whatever is your cost of acquisition, that should going to be reduced by the exempted amount earlier. So your cost will be 0. Your gain will be 60 lakh over here. Asset transfer before 3/5 years. So we have 3 sections having the same treatment: 54, 54B and 54D. We have 2 sections having the same concept, that is section 54EC and 54F. So in this case, the amount exempted earlier is reduced from cost of the asset, cost of acquisition. In this case, amount exempted earlier is going to be taxable. There is no impact on the cost of the asset sold. Suppose in this same example, 40 lakh was the capital gain. We invested in 54 EC security, 35 lakh. Our gain was 5 lakh. Then we transfer the security after 1 year. The sale consideration was 60. So we not change any cost. Cost will remain same, that is 35. So my gain is 25. And the gain exempted earlier is going to be taxable again. That was 35 lakh. So now you can see, technically we see the total amount taxable is 60 lakh. And again, the total amount taxable is 60 lakh. In both situations, the total amount is 60 lakh rupees taxable, whether you reduced it from the cost of acquisition or whether you are going to taxable the whole amount again as a gain. But there is one difference. And I just want you, all of you, to find that if the amount is taxable same, 60 lakh in this situation, when we are reducing the cost from the, when we are reducing the exemption from the cost, and even if we are not reducing the cost, still the amount of taxability in both situations is 60. But there is a difference arise. I want you to find what is the difference between the taxability of this 60 lakh rupees. If any one of can you find it, I am just waiting. If somebody know what is the difference in the taxability of this, then please let me know. I am waiting for your answers. Okay, Vishwanath Reddy is asking, sir, what if Mr. A sold 4 flats and purchased 1 house to the extent of capital gain? Is still exemption claim under section 54? When you are saying it's 4 flats, that means they are 4 separate assets. You have transferred 4 separate assets. Maximum 1 house exemption you can claim out of any capital gain of any 1 house. You cannot combine that. And any house has been sold, you can claim your exemption out of against any 1 house, 1 flat. What is the monetary limit for exemptions in 50B? Ms. Bhumika, there is no monetary limit under section 54B for the purpose of exemption. There is no amount, no limit. You can exempt as your capital gain. Whatever amount you invest, that will be exempted as your capital gain. Sir, can individual take both benefit 55 EC and 54 at the same building transfer? You can have the exemption on the basis of the investment amount. If you transfer any asset, you have the capital gain. If you utilize certain amount for the purpose of your purchasing a new residential house, you can claim that amount as exemption of section 54. And if you invest some amount in the bonds, yes, you can claim that exemption also from the same property up to the limit of 50 lakh. You can claim multiple exemption from the same capital gain if the applicability is there. Okay. Bhumika is saying differences of 35 lakh. No. Vaishali is saying first case में short term capital gain and second में long term capital gain. You are slightly correct or almost correct. You can see in this case, this 60 lakh whole amount will be short term capital gain. So the tax rate will be applicable as per short term capital gain. But in the second scenario, this 20 lakh, 5 lakh will be short term capital gain, but this is your exempted capital gain will be taxable again. So what was the exempted capital gain? It was long term capital gain. So the nature of capital gain will be different. In this, rate of tax as per long term capital gain will be applicable. On this, rate of tax as per short term capital gain will be applicable. And on this whole value, it will be a short term capital gain, and rate as per short term capital gain will be applicable. So the tax can be different due to the different rate of applicability, but the whole amount is still the same. But you should understand in the examination, you need to show that separately. This should be shown as short-term cap gain. This should be shown as long-term capital gain. That was section 54 EC. Now section 54F. So almost time has been. 54F is the last exemption section for us. So we will take this section in our next last session for capital gain. In the last session, we will have our MCQs. We will discuss section 54F, the taxability concept of long-term capital gain, short-term capital gain. We have three specific sections, section 111A, section 112A, section 112, and other kind of short-term capital gain. So we will discuss all these short-term capital gain, long-term capital gain taxability treatment in the next session, the provision regarding it, the MCQ, and test your knowledge question also. And some more question, which is from your study, we will discuss. Let me tell you one thing. For the purpose of capital gain, we have long-term capital gain, provision, and short-term. Long-term cap gain under section 112A, they have separate rate structure. 112 has separate provision. Short-term 111A having separate structure of rate, that is 15% taxability. This is having 10% taxability. This is having 20% taxability. And other short-term capital gain will form part of your slab rate taxability. So in short, I'm just explaining you that the different rates taxability for long term and short term. We also know this section 112A that belongs to equity shares, equity oriented fund, which has been transferred on that special provision what we discussed today, in which cost of acquisition provision was different. The tax rate is 10% without indexation. This is other long term, which do not fall under section 112A. That is other long term capital gain we are talking about under section 112. These are if the security on which 112A applicable is short term, then it will fall under section 111A and the rate is taxability is 15%. All other short term capital gain will form my slab rate taxability income. It might be 5%, 20%, 30%, depend upon the person's slab rate. So what it is, how it's going to be taxable, that we will discuss in our next session. So if there's any query, you can ask me, and after that we will close our session. Okay, under section 54, 54B, 54D lakh, 60 lakh is taxed as whole amount. Okay, fine. Aisha is telling the difference between the two concepts, 54, 54B and 54D, correct. The whole amount will be short-term capital gain. If you are not fulfilling the condition, if you are transferring it within before 3 years of expiry, then the whole amount will be a same nature, that is short-term capital gain, 60 lakh. And if it's section 54 EC or 54F, then the nature of gain will be different. So the taxability will be different. The amount exempted, this is going to be taxable, will always be long-term capital gain. And the balanced amount which is taxable for the new asset will be the short-term capital gain. Clear. So there is no more queries. So Ashok ji, we can wind up the session.